Let's continue with chapter number 12 from your economics book of grade 12, and the name of the chapter is Theory of Income and Employment. And today we are going to start from propensity to save, or you can say saving function or propensity. So propensity to save or saving function in the counterpart is the counterpart of the proportion function. The saving functions you can say shows the relationship between the level of savings and the level of income. According to Keynesian theory, they are saying the higher level of income will find that the higher amount of money is saved, and if you find the income is low, we will find the savings is also low. In simple terms, we can say that there is two sector of this income, that is the consumption and the savings. So in algebraically we can say that is savings, S is equal to Y minus C. Y is the income and C is the consumption. So income minus consumption is the savings. So savings and consumption are denoted here according to the Keynesian theory as the twins, that is CMC twins. Okay, so the more the income will increase, the savings will also increase. Now there are two saving concepts which are exactly analogs of the consumption concept, that is APC and MPC. These are average propensity of savings, that is APS, and the marginal propensity of savings, that is MPS. The average propensity of saving is the proportion of income that household want to save. It is derived by dividing total desired saving with the total income. So symbolically we can say that APS is equal to S by Y. Okay, so what is a marginal propensity to save? The marginal propensity to save relates the change in the total desire of savings to the change in the income that brought it about. MPS is the ratio of change in total desired saving is the change in the income. Okay, desire. Now let us come to the point, that is APS. What is APS? That is average propensity saving. Average propensity saving means, suppose today I am earning 10,000 rupees and I am saving every month maybe 1,000 rupees I am saving every month. So that is my average propensity saving. Okay, so with a certain income, with the increase in the income, okay, like from suddenly have started earning maybe 10,000 more. So now my present income will become 20,000. So I will not be saving 1,000 rupees anymore. So I will be starting to save more than that. That is 1,000 more I can save. So my saving will become 2,000. So this increment in the saving, with the increment, just because there is an increase in my income, I am increasing. So the percentage which is increasing, that is called the marginal propensity saving, that is MPS. As I always tell in my videos, that marginal means with additional of 1 unit what is the change. So with the additional income there is a change in my saving, so that change in the saving is called the marginal propensity saving. So as I told you, gave you an example that 2,000 will be my saving with my new income, but entire 2,000 is not the change, only 1,000 rupees extra I'm saving. So that 1,000 rupees is called as a marginal propensity saving. Hopefully you understood this one. Okay, next we are having, okay, next part is there in your determination of equilibrium. Determination of equilibrium, income and output. As I have always told you, what is the meaning of equilibrium? Where the opposite forces comes in a balance, that is called equilibrium. Here income and output is they are talking about. And there are two approaches to the determination of the equilibrium level of income. These are aggregate demand, aggregate supply approach. Another is the saving investment approach. Savings and investment approach. Here they are saying aggregate demand, aggregate supply approach. So first let us start with the aggregate demand and aggregate supply approach. Because in terms of aggregate demand, aggregate supply approach, equilibrium level of income and output in the economy is the one where the desired aggregate demand for goods and services is equal to the aggregate supply. The aggregate demand refers to the total desired expenditure of the commodity. Total desired expenditure comprises planned expenditure on consumers' goods by the households and planned investment expenditure on capital goods by the business firms. So in other words, we can say that aggregate supply refers to the value of total output of the goods and services produced in the economy in a year. In other words, aggregate supply is equal to the value of national product, that is the national income. Next, we are having the savings and the investment approach. Savings and the investment approach. According to this approach, equilibrium level of income is determined at that level where planned investment equals to the desired or planned savings. Okay, next we are having the investment multiplier, where you can understand by multiplier it is just multiplying and increasing. Okay, the investment is multiplying and increasing. A rise in the amount of desired aggregate demand due to the increase in the desired consumption expenditure or desired investment expenditure will result in an increase in equilibrium level of income and output. On the other hand, a fall in the desired aggregate demand will lower the equilibrium level of income and output. We explain the change in the equilibrium level of income and output in response to the change in the investment expenditure. Okay, last part, I think. Yes, last part. No, here. Investment multiplier definition, or how can we define it? The investment multiplier is defined as the multiple amount by which income increases as a result the increase in investment expenditure. In other words, we can say that the number of times income increases because of the increase in the investment is called the investment multiplier. So what is the process? How does it work? Let us begin with the situation when the economy is in equilibrium. Suppose let us take about the Reliance Industry Limited. Okay, spends rupees 100 crore in setting up a new plant, so a new factory. Initially, this will create more demand for goods and services required for the setting up of a new plant or a new factory. There will be more demand of machineries, materials, then you can say land, labor, services, electricity, etc. This will generate income for all those people who are associated with the establishment of this factory. There will be more output and income. As a result, national income in the first round will increase by an amount equal to the amount of investment, and income of the suppliers of the investment goods, income of the wage earners, etc., associated with the setting up of this new plant will increase by rupees 100 crore. But this is not the end of the story. The increase in the national income of rupees 100 crore will cause an increase in the disposable income, which in turn will include an increase in the consumption spending also. Hopefully you understood till this much. Thank you.